you talked about 6% earnings growth within the context of 8% nominal GDP. Can you help us understand why that matters?
Well, I think the basic question for the equity market is thinking about what's priced in. And I know, like, at some point, like, sometimes I start talking about what's priced in, and people are like, "Ah, that's so boring. Why are we talking about what's priced in?" But when you're trading the market, you got to trade it against what's priced in. That's all there is to it. Analysts are expecting 12. We've had, pretty mediocre earnings growth, like at the S&P 500 level. Quarterly earnings has been, from a macro guy's perspective, you look at the numbers, you think, well, it's kind of been flat for 2 years, basically, right? It means up a little bit this quarter. It kind of wiggled up and down, but like basically flat. And I'm sitting there thinking, well, my God, GDP growth, nominal GDP growth has been about as good as it will ever be in the rest of our lifetimes in the United States. And earnings are totally flat, and it's like, okay, well, heck, what happens when things get worse? How are they going to meet that earnings growth expectation that sits in the market in the event that, even in the good times, these companies are struggling to generate this type of nominal earnings that would get aligned with the types of expectations that are priced into the market. So that's the gap. That's the gap that I see. And also, to be clear, from that time, we've had interest rates rise a few hundred basis points. We've had, on the short end, on the long end, we've had the global economy, Europe and the UK slowing down. It's not like, there's a boom out there. And that's likely, the impact on U.S. companies is likely ahead rather than behind related to those issues as well.
Right. So, we've talked about this before about, the margin expansion that companies had over the last 2 years, that opportunity, that window's closing. It just seems to me that there are a lot of headwinds in terms of earnings growth going forward. Is that kind of what you're seeing? This, nominal GDP, you say, is as good as it's going to get. Does it just seem like that window's closing for those companies and we're in for some difficult quarters ahead?
Well, I think that again, from a macro perspective, when you look at it, how do companies make money? Either the top line sales have to grow really well, or they have to have margin expansion. And the way that you have margin expansion typically is through borrowing, the household in particular borrowing and spending, or really what's happening is their incomes aren't keeping up with the top line sales growth. And when you look at that picture today, on a forward-looking basis, it certainly looks like you've got a circumstance where nominal GDP growth will be lower in the future than it has been over the last 2 years. Because we've tightened, because global economy is slowing, et cetera. And then you look at the margin picture and it's like, well, the labor markets are pretty tight. Wage growth is a lagging indicator. The big reason why those companies were able to get such good margin improvement during essentially coming right out of the COVID crisis is because it just takes a while to negotiate the wages up. But now we're in a circumstance where, some people say, well, real wage growth is a good thing. And I think it's a good thing for the individual spender, but it's actually a terrible thing for a company. Companies don't want real wage growth. Companies want negative real wage growth. They want their prices of their goods to rise a lot faster than what they're paying their workers, because that's when their margins expand. So real wage growth from a company perspective, which is driven by the tight labor markets and the flow through of the previous inflation to wages eventually coming through, that's a bad outlook. So I don't know, from a macro perspective, it's not looking good.